Hey, Wealth Tubers! Today, we're diving into Kamala Harris's game-changing proposal to tax unrealized capital gains. Curious about how this could impact wealthy households and your financial strategy? Stick around as we break it down and explore what this means for you. The Kamala Harris campaign has recently rolled out one of its first major policy proposals, focusing on an ambitious tax plan. At the heart of this plan is a series of significant tax increases targeting corporations and wealthy households, projected to raise around $5 trillion over the next decade. Specifically, Harris's proposal draws heavily from the tax increases outlined in President Biden's budget released earlier this spring. One of the most talked about aspects of this proposal is the introduction of a new tax on unrealized capital gains. Both Biden and Harris have suggested imposing an annual tax on the static wealth of households valued at over $100 million. Under this plan, these ultra-wealthy households would be required to pay an annual minimum tax of 25% on their combined income and unrealized capital gains. This proposed tax is often referred to as a wealth tax. Its primary aim is to address the issue of wealthy individuals who evade taxation by relying on unsold and unrealized assets for their income. The challenge with taxing unrealized capital gains is that these gains represent potential value that hasn't been concretely realized through the sale of the asset. Consequently, taxpayers might end up paying taxes on value they never actually receive, which could potentially discourage long-term investments among wealthy households. Let's dive into the details and implications of this proposal.
What are unrealized capital gains?
Unrealized capital gains are the increases in the value of an asset while it remains unsold. Essentially, these gains are considered theoretical profits that exist on paper. For instance, imagine you purchase a stock at $10 per share. If the stock's value rises to $12 the next day, but you haven't sold it, the $2 increase is an unrealized capital gain. Although your net worth has increased by $2, this value could still fluctuate until you decide to sell the asset. On the other hand, realized capital gains occur when you sell an asset for more than its purchase price. The profit you make from this sale is termed as realized gains. These gains have a definitive, recorded value because they come from a completed transaction. Realized capital gains represent a fixed amount and are finalized when the asset is sold. In contrast, unrealized capital gains can vary as the asset's value changes. Taking our earlier example further, if your stock is worth $12 per share on July 1st and you sell it for $14 per share on August 1st, you'd have a $2 unrealized capital gain on July 1st and a $4 realized capital gain on August 1st. Capital gains apply to a broad range of capital assets, which typically include financial securities like stocks and bonds, as well as real estate properties.
What are realized capital gains taxes?
Capital gains taxes come into play whenever a capital asset is sold for a profit. Unlike unrealized capital gains, which refer to the increase in an asset's value while it remains unsold, realized capital gains taxes are triggered by a sale. This tax is calculated based on the profit from the sale, which is the difference between the sale price and the cost basis, typically the original purchase price of the asset. Currently, unrealized capital gains are not subject to taxation. The taxable event only occurs when an asset is sold and the gain is realized. This system has been a contentious issue in American politics and economics because capital gains, essentially income from passive investments, are taxed at lower rates compared to earned income, which comes from labor and work. Capital gains taxes are categorized into three brackets: 0%, 15%, and 20%. The highest tax rate of 20% applies to profits exceeding $500,000. In contrast, earned income can be taxed at rates up to 37%, depending on the level of annual income. For example, the 22% income tax bracket for 2024 starts at $47,150 of annual income. Supporters of the current system argue that lower taxes on capital gains foster investment and economic growth. By offering tax incentives for investments, the government encourages business creation, land development, and other productive economic activities. They also argue that this tax system prevents double taxation, as investors use money that has already been taxed to buy assets. Critics, however, contend that the system promotes rent-seeking behavior rather than productive investment. They argue that the preferential tax treatment for capital gains creates an inequitable situation where wealthy investors benefit from lower tax rates compared to lower-income workers. Critics also dispute the notion of double taxation, suggesting that investors should be taxed on their profits without special treatment.
How would an unrealized capital gains tax work?
The discussion around capital gains taxes isn't limited to just realized gains. Some policymakers and economists are now proposing a tax on unrealized capital gains, which would tax the increase in value of assets that haven't been sold yet. This is essentially a wealth tax. Under the Harris/Biden proposal, households with net assets exceeding $100 million would be required to pay a minimum tax of 25% on their combined income and unrealized capital gains. This tax would be assessed annually, likely based on the value of assets at the end of the year. For example, let's say a household holds a portfolio of stocks with an original tax basis of $50 million. By December 31st, the value of those shares has grown to $125 million. Additionally, the household has an annual income of $1 million and $10 million worth of stock options. In this scenario, the household would be subject to the proposed minimum tax because their net assets exceed $100 million. They would calculate their unrealized capital gains as $75 million, $125 million current value minus $50 million cost basis. With their total income and unrealized gains, the tax could amount to up to $19 million, 25% of $76 million. However, this presents a challenge. The value of the securities could drop back down to $50 million or even lower, meaning the household could end up paying taxes on gains they never actually realized. The specifics of this proposal are still speculative. Neither the Biden administration nor the Harris campaign have provided detailed plans on how they would implement or enforce this tax. Since no jurisdiction has yet established a wealth tax on securities, there's no existing framework to follow. This raises significant questions about valuation and enforcement, especially for private and illiquid assets where pricing can be more uncertain compared to publicly traded stocks and bonds.
The debate around wealth taxes.
The concept of a wealth tax has gained momentum in recent years as a way to address perceived issues with how the ultra-wealthy manage their assets. Currently, very wealthy individuals often avoid paying taxes by not selling their assets. Instead, they receive compensation in the form of stock and options, which can remain untaxed. They also use loans secured by these assets to access cash and property, further avoiding immediate taxation. This practice is known as buy, borrow, die, where individuals can effectively sidestep taxes by not triggering taxable events, keeping their wealth locked up and potentially avoiding taxation indefinitely. To counteract this, some policymakers have proposed implementing a wealth tax on unrealized capital gains. This approach aims to tax the increase in value of assets that have not yet been sold. Proponents argue that a wealth tax is necessary to ensure that ultra-wealthy households pay their fair share, generating revenue and forcing assets back into the market. By creating a tax event on unrealized gains, the goal is to reduce the practice of indefinitely holding untaxed assets. However, the idea of a wealth tax is not without its criticisms. A significant legal question arises regarding whether the federal government has the authority to tax individual assets without a transaction taking place. Critics point to the Fifth Amendment's Takings Clause, which states, "Nor shall private property be taken for public use without just compensation," and the Direct Taxation Clause, which reads, "No capitation or other direct tax shall be laid, unless in proportion to the census or enumeration herein before directed to be taken." These clauses raise concerns about the constitutionality of taxing unrealized gains. Most constitutional